Okay, so the stock market just broke, so we have to talk about it. Did you know that if you invested your money back in March of 2020, you still wouldn't be able to go back in time and do anything about it? I'm going to tell you anyway, though, because if you had put your money into the March lows of 2020, you would basically have doubled your money at this point, which is kind of crazy because usually it takes the stock market something like 10 years to double, and we just did it in a year. That's because of the rule of 72, right? So the rule of 72 just says take 72, I'm not sure why, it's just a number that works, and you divide that by the expected yearly returns. So in the stock market, that's usually 7%. So you divide 72 by 7 and you get something like 10.3, which is where we get your money doubling every 10 years, roughly. That's a neat little trick to figure that out. But for the first time ever, we have crossed 4,000. That has never happened before. It's over 9,000. Stupid Dragon Ball Z reference. But in March of 2020, the lowest we got was somewhere around 2,300 points, and now we're up over 4,000, which means we are going to go even higher. So let's talk about exactly what all of this means and what's about to happen. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the Binance, which is a crypto brokerage that I'm not sponsored by because I'm still not sponsored by anyone. I just said it because it rhymed. So anyway, the stock market hitting 4,000. What does that mean? Well, apparently it means that inflation isn't real, Kevin. No, he doesn't watch my videos. But inflation is super important. It's something we talk about a lot. It's something that a lot of us nerds here on YouTube like to debate. And the simplest and easiest way to understand what's going on is that anytime we are told as investors and to the public that inflation is going to increase, that's when investors get scared and they pull their money out of the market and they wait. And the stock market goes down. That's the bottom line. But anytime we're told that inflation's under control and that it's very low, that's when investors get super excited because they understand that this continual monetary expansion policy of lowering interest rates, which makes it easier for companies to borrow money for cheaper, which makes it easier for them to buy back stocks and to reinvest that money into something else that makes them even more money, creates this positive feedback loop of continually increasing the stock market. That's the technical explanation for what's going on. But here's why it's important to understand the relationship between inflation and interest rates and why that matters so much this week. So Papa Powell, that's this guy right here, his job is to sort of regulate the economy and bring balance to the force. So if you can imagine a scale with inflation on one end and interest rates on the other, the two act as sort of opposing forces to balance each other out. So Papa Powell, again, this guy and all the other bankers got together and started becoming worried when the pandemic hit because everything slowed down and shut off. And they started becoming worried that people would start hoarding their cash and saving all that money, which is exactly what ended up happening because in February of 2020, our savings rate was 8.3%. But by April, when we realized, oh, this pandemic's actually kind of real, that rate jumped up to 33.7%, which is the highest that it's ever been in recorded history as far back as that chart shows us, which dates back to 1960. That's over 60 years worth of data because people started saving their money because they also started losing their jobs, which makes perfect sense, right? But saving money is actually very bad for the economy. Even though my YouTube channel talks about saving money and being frugal and investing it, the saving part is actually very bad. And it's not because of the obvious reasons like cash is trash, you get left behind if you're not investing it. It actually goes a lot deeper than that. Here's the thing, saving money slows economic growth because of a concept related to liquidity. That's a fancy word I like to use, but I remember it because anytime I say liquidity, I think of a liquid, and the liquid I like to think about is oil because I'm down on my energy stocks and they haunt my dreams. No, I'm just kidding. It's because the economy is one giant machine that needs to continually be oiled up, right? You have to encourage this velocity of money to people continually to use it, to borrow it, to spend it. Otherwise, if banks stop lending, if people stop borrowing, bad things happen. So, to encourage the growth of the economy after the pandemic, Papa Powell dropped a giant beanbag on the interest rate side. Boom. So imagine that scale, interest and inflation. So he dropped the giant beanbag, interest rates went down, but on the other end, inflation, to encourage that growth as a side effect, asset prices went up as well. Now, what us nerds on YouTube disagree about is how quickly that inflation manifests itself and what actually counts as inflation in the first place. And this is something I'd love to hear your thoughts about, but maybe this is where we disagree. Some people like to only look at what's called the Consumer Price Index to see whether we have inflation or not. And they'll reference things like, see, eggs are still $3 a dozen, and chicken is still $3 a pound, and milk is still $5 a gallon. Apparently I live in Hawaii, and gas is still virtually the same. So see, inflation is not as bad as people are making it seem to be. But other people like to look at asset prices of things like stocks and real estate and cryptocurrency and think, what are you talking about, Willis? Because those are increasing in value very, very much. That's called asset inflation. And so they'll respond with, hold on, that's not actual inflation. That's just basic supply and demand economics. Because when you drop interest rates, that encourages people to buy more, and people are going to cheaper cities to save money, and so supply is low, and so prices are increasing. That's not inflation. And to that I respond with saying, well, yeah, but that's how inflation works. That's the mechanics of inflation because it regulates things like supply and demand. So that's mostly where we disagree. Now back to Papa Powell. Remember, one of his jobs is to continually reinforce and remind us that the expectation for inflation is very low. Why? Because he doesn't want to scare people. If he scares people, that scares investors. They pull their money out of the market goes down, and we only end up hurting the retirees, which we don't want. Because remember, the stock market is a very fickle place that's driven by emotional sentiment. It's not driven as much by corporate profits or even data as much as it is driven by human beliefs. And to strengthen those beliefs, we have to keep those interest rates very low because that's what spurs economic growth. This is the expansion of monetary policy that we're talking about. This is what heats up the economy, and that's why the stock market keeps going up and up and up. But that's just a theory.
A film theory.
I know I talk about this stuff a lot in my videos and I explain it, but it gets so complicated that sometimes even I need a refresher. But here's why all of this is so important and how it ties together. The pandemic has sort of created this perfect storm where we're finally seeing this inflation manifest itself and finally come alive, at least in the asset space. If you're someone like me who believes that asset inflation is equally important as consumer price inflation, because this is when truly the poorest people in our country get left behind the most, because then they become indentured servants to their jobs forever because they're forced to buy overpriced assets, and since their jobs are not enough to pay for them, they're forced to keep those jobs forever. And that's why they talk about this K-shaped recovery. But anyway, in one of my last videos, I talked about the best time for stocks, and that historically speaking, the best month for stocks has been April. That's when historically the stock market has gone up the most, and well, stock prices tend to increase. So we'll see if I'm right about that. But this 4,000 threshold mark is a psychological benefit because it tells investors, especially retail investors, that, oh wow, I need to put my money in, because they're the ones that get the most affected by exciting headlines like, the stock market's on fire, there's no stopping it. Then they hear all their friends are making money in the market, so of course they put their money in because of FOMO, fear of missing out, and so that increases stock prices all across the board because it creates this positive feedback loop that we on YouTube like to call the infinite monetization loop. So this 4,000 threshold sets us up for a huge month in April because, again, people hear 4,000 and they're like, well, that's more than 3,000. Andre 3000's evolved. So anyway, another thing we can take a look at that's really interesting is called the VIX, which is another graph or benchmark that sort of judges the stock market for the next 30 days. It's sort of like a fortune teller that tries to tell us the future about what's going to happen in the stock market. It can't tell us exactly which stocks are going to go up, but it can tell us how safe or how dangerous it is to start investing in the market, at least for the next 30 days. Here's how it does that, by the way. It takes a look at the options markets to see how sporadic the prices are. In other words, if the prices are high one day and then the next day they're down a lot and then they're back up again the next day, that signals to investors that the VIX is high, aka volatility is also high. So tread carefully because The stock market's behaving like a child right now. But when the VIX is low, that tells investors that volatility, sometimes it's a hard word to pronounce, volatility is also low, so maybe it's time to invest. So if we take a look at the VIX right now, it's actually standing at 17.33 as of April 1st, and it's actually declining, which is a good sign because that tells investors, hey, maybe I should put my money into it because the stock market is stabilizing. It's a good time to buy. So I'll go on record and say that I do think this month of April should be huge for the S&P 500, for stocks like VOO, assuming that nothing crazy bad happens out of the blue. By the way, the VIX also stands, or can sometimes be called, the CBOE Volatility Index. So if you ever hear that, that's what that means. CBOE just stands for Chicago Board Options Exchange. Useless piece of trivia. But wait! There's more, because a challenger appears. There's also the Biden stimulus plan. So here's what that means for stocks as well. I'll quickly run through it because I don't want to bore you. Too late, dude. It's called the American Jobs Plan, designed to help the middle class by spending over $2.25 trillion in the next 8 years. And the real winners from this bill are going to be the clean energy stocks, the electric car companies, because he's going to be extending the tax credits for another 10 additional years and give them $174 billion allocated towards electric car company incentives and tax credits, rebates, and for my portfolio anyway, stocks like Ventus and Welltower, which are healthcare REITs, are going to see some benefit from this. Stocks like AT&T and Verizon, because they're trying to lower broadband costs, are going to profit. Home builders like Lennar and D.R. Horton, which are some of the larger stocks building homes for people. I guess you can call them infrastructure stocks. Also stocks like railroad companies, like some of the slower ones. I own UNP, Union Pacific. That's going to see some help from the government as well. The losers, of course, are going to be the dirty energy stocks like Chevron and ExxonMobil, which of course I have plenty of. Maybe I'll sell my dirty energy stocks and finally take that plunge and buy Tesla or NIO or maybe ARKX. But honestly, I'm not a huge fan of buying mutual funds from hedge fund managers, even if they're extremely intelligent like Cathie Wood. Even though she got a lot of things right, it seems like they get rotated depending on their popularity, because if they're making money for people, great. People love them, and when they're not, and they lag behind the S&P 500, people forget about them. So for now, for me, it's broad market index funds all the way, and as far as the stock market is concerned, as long as we continue to have these low interest rates and all these stimulus plans, then asset prices across the board are going to continue to increase. And as far as the bill is concerned, I think it's a great idea. It's obviously going to create tens of millions of new jobs. And what's great is that we can't outsource them. That's the nature of infrastructure jobs, is they have to be kept here at home, obviously. And my only worry is that by increasing the corporate tax rates from 21 to 28% to fund this bill, we may see companies pass on those tax hikes in the form of increasing prices on consumers, but I don't think it'll be as bad as people think it'll be. And my only other concern is that it's going to get funded by increasing taxes on people making $400,000 a year, which means, come on, Joe. I just got this money, bro. I'm just kidding. I'm okay with paying more taxes. It's fine. Don't forget to grab up to $250 worth of free Bitcoin using this BlockFi link right here, blockfi.com/Andrei. And once you've done that, go get 2 free stocks with Webull by depositing $100 using the link down below. You'll get 2 free stocks, both of which could be valued up to $1,850. And once you get them, track them automatically with my spreadsheet link down below in my Patreon. And if you haven't already, go check out Millennial Money. It's a podcast channel with my friends Graham, Jeremy, and Kevin, and we talk a lot about nerdy money stuff. And of course, we post on Tuesdays at 6 p.m. Pacific. Love you. Thank you so much for watching this video. I will see you back here on Monday and Friday, sometimes a Wednesday. I'll see you soon. Bye-bye.